How does a fund like the Tata Multicap Fund help investors with this allocation dilemma?
What multi-cap fund is basically about investing in all market caps. At any point of time, you will have to be invested 25% each in large cap, mid cap and small cap. At least half of my portfolio should be invested into stocks which are either seeing some turnaround or are into an earnings upcycle. And this exposure, I call it as alpha.
Wanted to get your perspective of the broader economy, especially given the global volatility and geopolitical events that we've seen recently.
So from a negative 8% kind of benchmark return, we're closer to about similar amount of positive alpha over the benchmark. While we are lower than our September 24 highs at a broader level in the markets, our mid-cap indices has actually made a new high. So I mean that who would have thought or timed it well to be there at the right point of time?
Hi everyone, welcome to the 14th episode of Fundamentals. In this episode, we will talk about the Tata Multicap Fund, a diversified offering investing across large, mid and small cap stocks. We are joined by our fund manager of the Tata Multicap Fund, Miss Meeta Shetty. Hi Meeta.
Hi Akshay.
Hi. So before we get started and talk about the Tata Multicap Fund, I wanted to get your perspective of the broader economy, especially given the global volatility and geopolitical events that we've seen recently.
Yeah, right, Akshay. So I think that if you look at the last broadly about 2 odd years, especially from September 2024, since then, if you look at the Indian markets, they are clearly down from about 26,000 odd Nifty level. We are down to roughly about 24. We've seen also lows of around 22,000 in the interim period. That tells you a lot about what we've been seeing on the broader economy and other factors. That clearly is pointing out to that it's not been a great 1.5-2 year time frame. And if you look at the reasons why it's happened so, I think you can categorically now in hindsight, you can categorically point out to 3 key factors. First is that, because we were riding on very strong growth, our Nifty EPS was growing in mid-teens, and we were coming off the COVID lows. We've clearly seen a very great run on the markets. And what that led to was that our valuation started looking a little punchy. So we were trading at roughly about 23 times, 24 times
right.
forward, right? So we were sitting at a higher valuation. That is the one aspect of what we've seen over the last 2 years. Second is that if you look at the Nifty earnings growth, that also started actually deteriorating from about mid-teens growth on the Nifty EPS numbers, which we saw for over 3 to 4 year back-to-back, in a row. That kind of collapsed to just single-digit number.
Okay.
And sitting on a higher valuation, obviously lower growth was not something that markets were clearly cherishing. And over and above that, of course, the layer was on the geopolitical side, whatever happened. So it started off with tariff noise. Then, of course, we've seen the war, the crude price escalation. All of those worries obviously weighed on the sentiments of the Indian markets. And which is why we've seen what we've seen over the last year and a half. Now, if you look at what lies ahead, I think that on the geopolitical side, at least it looks like that we are coming to a little reasonable scenario. Crude obviously has corrected, and that's the biggest worry for us sitting in India. So that is clearly showing some signs that geopolitical worries are probably behind us. We'll see what happens on tariff, but also those noises and the number or the percentage that now we are at, it looks that we are in a comfortable zone even on those aspects. So now the pivot shifts to exactly how our earnings growth is going to look like. Now, after 2 single-digit growth years, we are finally looking at a mid-teens kind of growth coming back, both in FY27 and in FY28. And that would mean that we are back on the growth trajectory. Even if you look at the Indian GDP number, which had collapsed to single-digit nominal growth, is kind of inching higher to about 9.5, 10ish kind of number. So all those things are giving us a lot of confidence on the growth. And the third aspect, which was the valuation, because of this 1.5 years of correction that we've seen in the markets, valuations have also started looking more reasonable. I would not say we are very attractive, but we are pretty reasonable versus where we were. So we are roughly about 19.5 times 1 year forward from about 23, 24 band that we were. So I think that we've come a long way over the last 1.5 years of stagnant market or corrections and volatility. Now things are looking much better as we look for the next 2 to 3 years.
Understood. And given the background you just shared, investors often debate about whether to invest in large cap stocks, mid cap stocks, or small cap stocks, and how they should allocate to each of this. How does a fund like the Tata Multicap Fund help investors with this allocation dilemma?
Right. In fact, Akshay, this multi-cap category solves that problem. What multi-cap fund is basically about investing in all market caps.
That's right.
And there is a very strong guardrail. So the mandate of a multi-cap category is that at any point of time, you will have to be invested 25% each in large cap, mid cap, and small cap. And the remaining 25% is on the discretion of the fund manager as to which market cap it wants to invest. So what this does is that at any point of time, as an investor, if you're invested into a multi-cap category, you are by discipline always there in all the three market caps. So you are not, juggling to take a call as to which market cap do you want to go and whether you will get the entry points right, or you are basically leaving that at the discretion of fund manager for the remaining 25, and you're always as a discipline invested into all the three market caps. So it solves the big problem of capital allocation across market caps. So that is why I think that this category stands out because of the discipline that it has in itself.
Understood. So it helps with the diversified allocations.
Absolutely.
Got it. And from an overall portfolio construction perspective, I've noticed that since you've taken over this fund, I think early last year, you focused on companies with either strong cash flows or strong earnings quality. Can you just share your thought process behind these selections?
Sure. So I took over this fund in Jan 2025. And as a fund manager, my approach always has been that at least half of my portfolio should be invested into stocks which are either seeing some turnaround or are into an earnings upcycle, which was probably lagging or slower in the earlier years. Now, what this does is that we not only try to capture the growth revival aspect here, but we also end up getting a good re-rating element in this. Because usually when growth comes back, you see the valuations also start re-rating. And this exposure, I call it as alpha. So at least 50% of my fund, I always at any point of time would be wanting to invest it into alpha ideas. Now there can be times when alpha ideas have already done well and then I'm into the process of rebalancing, etc. And in the interim we may see some shifts, but as a fund manager, I would always want to have the portfolio into alpha ideas up to 50% of the allocation. The remaining 50 is basically the earning stability part, wherein all I'm trying to do is that stable companies may not have a re-rating element into it, but then they are compounders. They will keep compounding and they will hold the portfolio steady in a volatile time. So that's exactly what we did. Just rebalanced as to what my mind frame is or my way is to handle a fund. And in that journey, we ended up adding a lot of healthcare names. We added a lot of discretionary names. We added a lot of services names. And we also parted ways with companies where, while they were looking like a turnaround story, but at least we were nowhere closer to that. So, while alpha idea is about turnaround, but buying it too early in the cycle also hurts the portfolio. And that's what I try to avoid when I'm trying to build the alpha. So that's exactly what we did, and I think that really worked well. So from a negative 8% kind of benchmark return, we're closer to about similar amount of positive alpha over the benchmark. So yeah, I think it worked well, and we hope that it'll continue to do as we anticipate it to.
So what I understand is you follow a framework for earnings. I think it's earnings stability, earnings upgrades, and earnings turnaround.
Yeah.
So within each of these three pockets, where do you see the stocks or the pockets of opportunity?
So I would say that clearly, as I was mentioning, that the growth on the broader Nifty EPS is kind of coming back. And what are the levers for that? I think there are multiple levers to it. We are seeing the banking sector clearly do a good comeback, while our broader markets are still lower than our September 24 highs.
Yeah.
But if you look at the banking index, that's clearly showing you a lot of strength. It's higher than where we were at that point of time. So that is clearly one emerging trend. And what we've also done in the multi-cap category is that we went overweight in the sector in the past few quarters to few months. That's something that I'm clearly looking at. Even if you look at the credit growth, where we had slipped to low double digits, we have come back to a high teens kind of growth number. So that's showing the strength, and what we envisage is actually unfolding. I think that piece on the valuation front still has a lot of room, and with growth stability coming back and looking higher, we are going to see that sector remain in the momentum because of the lower valuations. So that is one area. Second is, I think that if you look at the entire manufacturing bit, while the talks on the manufacturing have been there since COVID days, where we were talking about China plus one, government came out with a lot of PLI schemes, that has clearly moved the needle. So if you look at India as a country whose percentage of GDP from manufacturing was in low teens to mid teens, have started inching towards high teens number. From about 14% we are inching towards 18% now. And that, I think, will clearly see a lot more legs of growth as we go ahead. And interestingly, if you look at China's contribution from manufacturing to GDP, has actually slipped from 31% to roughly about 24-25%. So we're clearly seeing that shift happening. We've seen in a large way that happen on the electronics manufacturing side. But I think that there are a lot more areas, including the EMS, of course, but there are a lot more areas where we'll see that. Parallelly, we've also gone ahead and signed FTAs with a lot more countries. We will see UK finally firing for us. EU we've just signed, and probably next year is somewhere we will see the revenue accretion happening. So we've clearly seen that journey that we've taken over the last few years. Now reflecting on the growth side even more. We have seen some of that, but I think that'll kind of pick up pace. So that is the second area where I am clearly looking for opportunities across length and breadth, not only on the EMS side. So I would say that is one. Third is, if you look at the data center capacity in India, currently we are sitting at about 1.5 gigawatt. And going by the reports that peg anywhere between 7 to even 11 gigawatt kind of capacity that we would see in the next 4 to 5 years. I would say that there is a lot of growth that will be backed by this. And it will be across length and breadth, of course, not only the end colo players, but you will also see it across the ecosystem, be it your genset players, be it your wires and cables. Power, of course, will be a big beneficiary, and the entire ecosystem, the component guys. So I would say that that's again going to be an area of interest where at least I would see opportunities and try to capture them. Some bit of both the manufacturing and the data center plays we have already included in our portfolio, and we already have it. But I would see opportunities where I can probably add more into that segment. So these are the three: banks, your manufacturing, and your data center area. That's where I would say that a lot of my alpha today probably looking into that area. And of course, this compounder stability is something that we keep eyeing. Interestingly, if you look at the multi-cap fund that I manage, the Tata Multicap Fund, every 3 months you've seen the top holding change here. So we've been very active, proactive here. And, because markets have been very volatile, we've also got opportunities to be a little, have a little tactical angle to this. And we are continuously doing that. And that is something that we will continue to do.
Okay, understood. So from a sector perspective, you are overweight on consumption, manufacturing, and perhaps power, given the AI and data center story you mentioned, and probably underweight on IT. Could you just share some thoughts on overall allocation, and how do you see IT given the overall AI growth story that is emerging globally?
Right. Just on the overweight part, so we are decisively overweight on healthcare and services very clearly. And on banking, we've just moved to an overweight position from an equal weight position. Rest, we are more or less equal weight, and we are seeing opportunities. Coming to your question on IT, so yes, we have an underweight stance here. We are roughly about 3% versus the benchmark weight of about 5.5, 6. And that call was largely because of the fact that, while I continue to believe that the IT services companies will have a role to play when the GenAI adoption starts at an enterprise level. Currently, all we are seeing is more of consumerization of that, where you and I kind of use it. But at an enterprise level, we are still at a POC level. It's just at a proof of concept. And the large-scale adoption is not yet started. Whenever that pivot happens, I think IT services will have a role to play. But in the interim, what is happening is that because AI is already there at the periphery of the enterprise, there is a lot of renegotiation that is happening, which is leading to productivity pass. The ask is very high for the productivities to get passed on. And the growth curve emerging out of GenAI is probably still a few quarters away, which is why we are in a disruption phase at this point of time. And hence we've seen the sector also behave the way it has. It is corrected over 25% in the last year and a half. So what we are seeing is that while the medium to long term still remains attractive in terms of growth reviving, but in the interim we are going to be into a disruption phase, and that is why we have taken this stance of being underweight in the fund for Tata Multicap.
Understood. Thanks for sharing your insights on how you go about the portfolio construction. Just from an investor perspective, so from a risk reward perspective and from an investment horizon, who is the Tata Multicap Fund most ideal for?
Right. So I would say that while multicap as a category, as I already explained, has its own discipline of always being invested into mid, large and small at any point of time, what this does is that it gives you a broad range of playing the India growth story. Because today, if you look at the categorization as we have, there are so many sectors which are only part of the mid or the small cap. And, if you are going to choose to stay in any one of the categories, you're clearly going to miss on the other one. So any investor who is looking to benefit from the broad scale growth that we as a country are going to see in the next coming years and decades, then I think multicap clearly does a lot of justice to that. Second is that investors who are probably thinking that they can take a call across when to be in multi-cap, small, mid-cap, small cap or large cap. I think that not everybody will be able to do it in a timely manner. I mean, just think of it, right? That while we are lower than our September 24 highs at a broader level in the markets, our mid-cap indices has actually made a new high. So I mean that who would have thought or timed it well to be there at the right point of time? So at least this discipline of always being invested into these three segments at any point of time clearly allows you to take that broader call and always be there and benefit from the the growth that we're going to see. Of course, it can be slightly more volatile in the interim period, but an investor with a broader horizon of 5 to 7 years and it has a little more risk appetite than a pure play hybrid or a large cap fund owner, I think this is clearly a very good category to look at.
Understood. So, for investors with a slightly longer time horizon and looking for diversification along with discipline, they should definitely consider the Tata Multicap Fund.
Absolutely.
Understood. That's clear. Thank you, Meeta, for joining us in this episode of Fundamentals.
Thank you, Akshay. Thank you for the opportunity. Thank you, everyone.
So, as we heard from the fund manager of Tata Multicap Fund, investors looking for a diversified exposure while maintaining discipline across large, mid and small cap categories should consider investing in the Tata Multicap Fund. We hope this has been insightful. Thank you for joining.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.